Ladies and gentlemen, welcome to this special podcast. Today we have a returning guest to the show, Keith Weiner from Monetary Metals, located at monetarymetals.com. That's monetary-metals.com. And I got to tell you, gold and silver have started wild rides in 2022 so far. From finishing the month of January down somewhat in price to finishing the month of February with a bang, there has been a ton of interesting price action. Complicating things, now all of a sudden the dollar has become a hot topic of conversation. So we've got to figure out some of the dynamics that are unfolding in the market so that we can maybe get a sense of where things are headed on Main Street. And when it comes to gold, silver, the dollar, and the economy, we really need to be able to digest and dissect both the macro side of things and the micro side of things. And I can't think of a better person to do that than Keith Weiner. So Keith, I'd like to thank you for joining us again on Silver Doctors.
Thanks for that intro.
Now, Keith, we've got to start out talking about silver. That's my favorite topic to talk about in the whole world. And you got to hear me out for a minute, Keith, because I got to say a couple things to lead into this question. So let me just say something about a couple articles I wrote last summer and last fall. And I want to get your thoughts on this, because last summer and last fall I wrote an article about the price of pickup trucks and about inflation and about the price of silver. And the gist of my article was this, Keith. The price of silver should be $88. So that was the gist of my article. Right now, the price of silver should be $88. So here's where you got to hear me out for just a minute, Keith. So, why I said that was based on the BLS inflation calculator. Now, I don't know if you've ever used that inflation calculator, and I'll link it in the description below, but basically you can put in any price and you can put in any date, and then you can say, well, what would that be worth in purchasing power in X year? So what I did was I looked at the Ford F-150, all this truck appreciating in value and microchip shortages and this and that. So I looked at the price of that Ford F-150 in 1980. And I researched prices, and JD Power shows your basic work truck in 1980, half-ton, long wheelbase, was about $5,785 MSRP. Now, if you plug that number into the inflation calculator at the BLS's website for January 1980, according to the BLS, that purchasing power is equal to $20,289 in 2021 when I wrote that article. Now I've checked, and you can't buy a Ford F-150 for 20 grand, but that's not the point. The point is, according to the BLS, that's the purchasing power. So if we take the price of silver, which last year was ironically the same price as it is right now at 25, if you put 25 in there from January 1980 when silver was topping at 50, right? If you put 25 in there, then according to the BLS calculator, that price should be worth the purchasing power right now, $88 in 2021 at the time, dollar terms. So I'm probably like going around in circles and ranting and raving here. Because the other point is, you can't hedonically adjust the price of silver too, right? So somehow you can miraculously say that the pickup truck only cost $5,785 in 2021, but an ounce of silver is an ounce of silver is an ounce of silver. So Keith, just based on the fact that according to the BLS, the price should be $88, I want to just ask you, what are your thoughts about what the price of silver should be, Keith?
Well, thanks for that long lead up. All I'm going to say regarding hedonic adjustments, AM radio, baby. That's what that thing had in 1980. I had a 1979 diesel Chevy Chevette. It came with an AM radio and had those buttons for the presets, and you had to push in the button and it would change channels. And let's just say cars today are hedonically nicer. But leaving that aside, I think that, in my writings, I call this a tempting and convenient idea to, we all know the dollar is going down in value. In fact, it's not a conspiracy theory, it's the official stated policy on federalreserve.gov to devalue the dollar at a rate of 2% per year. So we know it's going down. It's very tempting and convenient to say, let's take consumer goods and use that to measure the dollar. And so if consumer goods double in price, then that means the dollar is halved in value, and therefore all prices should approximately double. And if they don't, well, we can, wave our hands and say Cantillon effect or leads and lags or whatever. I just don't think that theory is, is quite right. And then obviously to your point about hedonic adjustment, an ounce of silver in 1980 is, an ounce of silver today, it's actually the same ounce. The truck is not the same at all. I was just driving home from Las Vegas yesterday, noticing that it seems like the average speed of the average car is much higher over the last, let's say, 5 years. So people are just simply driving faster. And I think, maybe people are a little fed up with COVID and just a little bit more pissed off at the world about everything that's going on. And maybe that's, possible. People are pushing their right foot down on that pedal. But I think part of it is cars are just simply better. If you're driving around a 1980 pickup truck, I think 55 miles an hour is already starting to feel pretty exciting. Every time that truck would jounce on a, pavement joint or a little pebble or whatever, you kind of feel like it's a little floaty, like you're not really entirely in control of that vehicle at 55 miles an hour. Today, that F-150 feels rock solid at 80, which, in 1980, that was like sports cars were pretty good at 80, but most other cars weren't.
If I could piggyback on your point real quick and interrupt, I totally get what you're saying about that, because I've actually had like over 30 cars. I lost count, but one of them was a 1984 Isuzu Trooper 2, and it was a 4-speed manual. And I kid you not, like in fourth gear, floored, giving it as much as it could, it wouldn't break 55 miles per hour driving. It's like, that's the limit. It's like red line, floor to the pedal, gas going 55 miles an hour. But go ahead and continue, because I see that point exactly about, yes, like mechanically, they actually do go much faster now, just on my experience as well. But continue your point, Keith.
And not just faster, but actually feel safer at much higher speeds back in compared to those cars. But anyways, I think the point is that we measure consumer prices in dollars. There's something not quite right about measuring the dollar using consumer prices. It becomes circular and self-referential, and it isn't really measuring, what people think that it's measuring. But I'll go further, and I've lost track of how many articles over how many years. The topic that I call useless ingredients, or mandatory useless ingredients, and thinking about, two in particular. One is that in the summer, gas stations have to blend either ethanol or MBTE into the gasoline, which adds cost, but adds no value, or actually maybe reduces value. That is, you're getting less energy in a gallon of gas with that additive added than you'd get if if the gas was pure. And so everywhere you look, and the other one I always look at is bread, where in order to sell bread, there's certain preservatives that are mandated. But everywhere you look, there's a regulator forcing the producers of everything to add stuff that the consumer does not value. That's why it has to be forced. If the consumer wanted it, of course, you wouldn't need the government to pass a law that says, all shirts should have buttons. Well, nobody would buy a shirt that, a shirt like this that had a opening in the front. Nobody would buy it if it didn't have buttons. So they're forcing, producers everywhere to add stuff that people don't value, and usually in most cases don't even know is there. Don't even know. I mean, everybody's kind of aware of ethanol and gasoline. Are they aware of the preservatives in bread? Are they aware of the ADA compliance costs in every restaurant? Not usually. They don't think about it that way, and unless you've ever built out the interior of a commercial space and you realize, number one, bathroom space is the most expensive space to build, and number two is you start thinking about revenue per square foot. Not only is the bathroom not revenue producing, but all the extra hallway and corridor space to get to and from the bathrooms is not revenue producing. You realize all that stuff is a cost, and all those costs come out somewhere and generally push up the price of the product or the service to the consumer. And my point is, this is not a monetary force. This is a non-monetary, thing. People aren't really aware of it, and so it's easy for them to think, okay, if the price of consumer goods doubled, then that means the value of the dollar halved. And my response to that is, the dollar is buying as much as it did before. It's just buying all sorts of things. It's buying lawyers' time, and it's buying regulatory compliance inspectors' time, and it's buying, all this ethanol and MBTE. It's buying all sorts of other things. Just because you don't value it doesn't mean it isn't being bought when you fork over your dollars at the gas station. In the wake of COVID, there's several other non-monetary forces that I think needs to be discussed. One, which is kind of predates COVID, but we're seeing now in COVID, it's hitting with all the others, and that is what I call more broadly trade war. It's not just tariffs, although the U.S. recently doubled the tariff on imported Canadian lumber. The U.S. recently banned imports of avocados from Mexico, although they let go on that. There was at least a brief time when, the entire, 90% of the avocado supply was now, blocked from being imported. But, every corporate supply chain manager, from semiconductors to automobiles to, you name it, has to be looking at this issue. What jurisdictions are we buying components from? And what are the implications of that? And what happens if that jurisdiction, something were to happen either politically, if we get, Trump in 2024 or another conservative of that mindset, and then, further, regulations or tariffs come down the line, to what happens if China were to try to annex Taiwan the way Russia is annexing Ukraine as we speak. And I think there's a giant mad scramble to either onshore or at least look for new jurisdictions compared to what the world had been, let's say, prior to 2016. All of that has a cost. I mean, there's a reason why people were buying from Taiwan, and that is Taiwan was a better source compared to wherever they're planning on buying, going forward. And so whenever somebody's forced to move from their first best to their second best, thing, then costs go up. So I think costs are going up everywhere, supply chain related. The third thing that has to be discussed, obviously, in the wake of COVID, is the lockdown that occurred, but then the unlocking. And I kind of liken it to, imagine you have this steel cable and you winch it tighter and tighter and tighter, and then, eventually you cut the cable. The cable doesn't just part and just drop to the ground.
No.
It will let go with a horrific force. You don't want to be anywhere near that. And so that's what's happened as they've let go of lockdown. The entire global shipping and logistics industry has been thrown into, disarray, initially because ships and other assets were in the wrong places. Eventually, a lot of other, bottlenecks arose, particularly because these are highly regulated businesses. Regulation makes industry sluggish to respond, very sclerotic because they don't have the, freedom to operate. So in LA, you can't operate 24 hours a day because there's regulations about that. You can't stack shipping containers more than 2 high. There's so many regulations that's make your head, spin. And then finally is what I call green energy restrictions, and particularly in Europe, where the price of oil and gas is much, much, much higher than it is here. So I look in the UK, we have some of this here in the US, but it's not nearly as bad. This is pre-COVID. They passed these 2 different laws. One, forcing I shouldn't say all, but most of the domestic consumers of coal and oil, which would be heavy industry and electric generation, to switch from coal and oil to natural gas. And then another law forcing the shutdown of all the domestic natural gas production, which was by fracking, and making fracking illegal. So you can't produce it domestically anymore, and then all the domestic consumers are now forced to use it. So obviously that drives up costs, and it makes the UK more dependent on our friendly dictator, Vladimir Putin. And then, obviously we all know what Vladimir Putin is doing as we discuss this. But now add synergistically this green energy restriction in the UK and the logistics and shipping nightmare in the wake of COVID, and they synergistically combine and make something that's much worse than either of them, alone would cause. And so, the shipping snafu says you can't get Christmas tree ornaments from China or anything else because, shipping is all messed up. And now you have a country that has forced itself to be dependent on shipping in natural gas. And now you can't ship anything, including even Christmas tree ornaments. So suddenly there's giant shortages, leading to not only the price of natural gas spiking, but downstream of natural gas is used to produce fertilizer. So suddenly the farmers in the UK are saying, we're not going to be able to plant crops this year because the fertilizer plants have shut down because there isn't enough natural gas anymore. And, as when you get to shortages, usually often the government starts to impose, industrial policy and starts to allocate resources. You get it, you don't, blah, 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 blah. Now, a byproduct of fertilizer manufacturing using natural gas is pure CO2, which is used in slaughtering animals, and it's also used to make dry ice for shipping food. So not only aren't they going to be able to produce food domestically, but they can't ship frozen food because of lack of dry ice. So, they're going to have what will be called food inflation, and this will be assumed to be a monetary, factor, that the pound is collapsing in value because its purchasing power is falling. And if you trace it all the way back, you can see some very non-monetary, forces being imposed here, which isn't to say the pound isn't losing value, but in addition to that, there are these other four factors, which are mandatory useless ingredients, lockdown whiplash, green energy restrictions, and trade war. And the combination of all four is that certain prices are absolutely skyrocketing. But that does not necessarily translate into a skyrocketing price of gold or silver.
Very interesting. And I know that just from past conversations with you, you have focused a lot on the useless ingredients. So just kind of like is there just like a general, as far as like the useless ingredients are only about half of what's causing this inflation now, and all this other stuff as far as these non-monetary forces are having a much more impactful impact on consumer prices? Would you say that? Or
yeah, I mean, useless ingredients are kind of the backdrop, but they're also not the change at the margin. So useless ingredients were here before prices began to go bananas in 2021. And so I would say, right, the change at the margin is, the whiplash of unlock combined with, trade war, and then having some very, very, very strong synergies with certain green energy restrictions. But that's very jurisdiction dependent.
mm-hmm.
So I'm sure that the price of gasoline in the Houston area is not going crazy, but in New England it might be, because New England voters voted to block certain pipelines.
Mm-hmm. Mm-hmm.
And the same thing with natural gas. So natural gas in the UK, I think the last I'd looked was 5 or 10 times the cost of what it is here, something like that. But yeah, I would say it's those right now, and the synergies of those things more than useless ingredients per se.
Now, Keith, so while we're on this topic, I want to kind of shift a little bit to de-dollarization and the topic of the dollar and the move away from the dollar, because over the last week especially, right? Over the last week especially, there's been a lot of talk about sanctions, and there's been a lot of talk about de-dollarization and the move away from the US dollar. And I just want to say two things really quick, Keith. First of all, arguably the world is dollar based, right? So if we're talking about, you can't use the dollar anymore, well, I mean, okay, wheat is still priced in dollars. I know how much the wheat is worth, even if I can't use the dollar. Or oil is still priced in dollars, generally speaking, or at least I know what the price of oil in dollars is. Or aluminum. I know how much, if I have, how many tons of aluminum, I know how much that's worth in a dollar-based price, even if I can't use the dollar. So that's point number one. Point number two is, what if I needed to stock up on refried beans and toilet paper from Costco, but I wasn't a card-carrying member of the club, right? So if I'm not a card-carrying member of the club and I need to stock up on refried beans and toilet paper, well, I can just tell my buddy to go buy that stuff in Costco for me. So that's point number two. So when I hear about de-dollarization, the whole thing kind of seems silly to me. And I don't know if that's a gross oversimplification of it or what, but it's like, we've been hearing this de-dollarization song for decades, Keith, right? Oh, everybody's moving. They're ditching the dollar right now. They're ditching the dollar, this game changer, this game changer. And it's like, well, I mean, the dollar isn't the only irredeemable currency game in town, right, Keith? So what am I missing about all of this newfound surge and talk about de-dollarization and the move away from the dollar, Keith?
Well, I think you hit the nail on the head. People have been saying it for decades. Hasn't happened yet. And, if you look at why, number one, the other currencies are all dollar derivatives. Now, arguably, maybe the North Korean currency is not a dollar derivative. Perhaps the currency of Cuba is not a dollar derivative. Maybe pretty soon the Russian ruble will not be a dollar derivative. I think it's a little more dubious. Now, I have to say, I'm not an expert on the geopolitics of Ukraine or Russia. So I'm going to try to avoid getting outside an area that I feel comfortable about. But it does look to me as if they're trying to cut Russia out of the payment system, but at the same time, not disable the ability of Germany and Europe to pay for oil that they desperately need. So we're cutting them out of the payment system, but not really. Whatever that means, and I'm not sure the mechanics of that. Maybe Putin will promise them, yeah, we'll only use the payment system, wink, wink, nudge, nudge, just for the oil. We'll never use it for anything else. I don't know what that all means. But I think, taking a step back, everybody is aware of, the issue that if you're a country and you borrow in a currency that you can't print, and most countries are in this position. I mean, the U.S., it's called exorbitant privilege. Even the European member nations don't quite have that situation, but the UK does, Japan does, to name two. But if you have to borrow in a currency that you can't print, you can get into deep trouble, not just because, okay, you can't print it and get your way out of debt, but rather the value of the currency that you owe can go up relative to your own currency. And since your revenues are in your local currency, but the debt that you have to service is in this other currency, let's say the dollar, you can get absolutely crushed. And it was kind of ironic to me when everybody was talking about the so-called BRICS. This was, I guess, after the previous crisis, 2009, 2010, 2011. And when you look at India as a basket case, and Russia as a murderous dictatorship, and China as something not that far from a murderous dictatorship. Okay, Brazil is interesting. Brazil was complaining at the time that their own currency was going up too much. And the theory is that if your currency goes up, then that harms jobs and GDP and all kinds of other things. Well, after that, in the next little downturn, the Brazilian currency was dropping, and then they were complaining in the other direction. I said, well, which way do you want it, guys? But anyways, when your currency is falling, it's much worse. So everybody understands this problem, but there's a reason why they borrow dollars. It's not that they're stupid, and it's not that they're ignorant. It's that if you want the credit, there aren't necessarily a lot of lenders, if any lenders, that are willing to lend you your local currency, because they know that the whole purpose of that currency is to go down. They'll lend you dollars because they know you can't make the dollar go down to ease your debt burden. And so they're forced to turn to dollars because that's where the credit is. It's the old, was it Bonnie and Clyde or Billy the Kid? Somebody's like, why do you rob banks? And he said, that's where the money is. Obviously, twisting on the meaning of the question. But, that's where they're going to get their credit. And that's number one. Number two, they have dollar debts. And, presumably they already have strong reasons to want to default on those debts, but presumably also have strong reasons why they don't want to default on those debts. Otherwise, they would already have done so. So you owe dollars, which means you're not getting out of the dollar anytime soon, and you need dollar credit because that's the only credit you're going to get. No one's going to lend you in whatever your local currency. So I would say, speaking of the de-dollarization meme, it's kind of like, the internet runs on TCP/IP. We could sooner speak of the TCP/IP-ification of the internet. There's such a strong network effect that it's not a matter of, the United States can kick Russia out of the SWIFT system. That means they could kick us out of the SWIFT system. Therefore, let's leave the dollar. It isn't as simple as that. And The dollar might be the greatest thing that everybody loves to hate, that still everybody craves. And I guess to put a fine point on this for anybody watching this, people say, well, Keith, you shill for the Fed or whatever. What I'm trying to do is I'm trying to describe the perversities. This is all very perverse. But to really understand, if you want to solve a problem, you got to really understand the problem. And in the case of the dollar, it's understanding the perversities of what's driving the system. None of this is getting good. This is horrible, but it's kind of how it works. And it's not going to change how it works just because we're booting, Russia out of the SWIFT system, or halfway booting them out, or whatever it is we're doing right now.
Mm-hmm. Because with your analogy to the internet is still going to be there, and people are still going to be able to send and receive data over the internet. So whether there's this SWIFT thing or not, or whether it's something else, there's still going to be networks, and people are still going to be sending and receiving data or money in that case. Am I understanding that correctly?
Yeah, well, suppose that Russia says we're going to create our own payment system. And with China, they have something called CIPS. You could make a new networking protocol tomorrow, and you could hook up with your friends, but no one else in the entire rest of the world necessarily wants to be on the, Silver Doctors TCP/IP version. They want to be on, the real TCP/IP version.
Right.
You can fork Bitcoin and call it Bitcoin Silver Doctor, Bitcoin SD, but the world wants Bitcoin regular, right? And that's it's the same thing with the dollar system. They crave the credit. They have to service their debts. They need the revenues, and in most countries around the world, even the locals don't necessarily trust their own paper currency. I've met with pension funds in other countries, let's say in Southeast Asia, and their balance sheets, I don't know if they're quite denominated in dollars, but that's how they think. That's how the pension fund managers are managing it, not to the local currency, which they realize is, it goes down. And none of that's going to change just because the U.S. did something to Russia with the SWIFT system.
That wasn't even really something when we do the wink wink thing and get around it in that sense.
I don't even know the details of that, but yeah, even if it was real, and then there's also a perversity to that, right? So people are saying, well, look, the U.S. can be arbitrary and capricious by booting somebody of the SWIFT system, but let's ignore the arbitrary and capriciousness of taking over Ukraine, or if you want to look at China, taking over Hong Kong and threatening to take over Taiwan. That's not arbitrary and capricious, and everybody's going to be running into their open arms, whereas the U.S. says boo about SWIFT and everybody is going to run away. I'm not sure the world necessarily works that way, but just strictly speaking from a monetary economics perspective, the dollar has such a strong network effect that, even if somebody hates it, I challenge people to think of it this way. I presume most of the viewers of this show, have an affinity for gold and especially silver. Imagine if you have a job, go into your boss and say, I want to rewrite my employment agreement. I want, whatever, 2 ounces of silver per hour, and I want a 5-year contract on that. He's not going to agree. So what you want as an individual doesn't outweigh what the market is willing and able to provide, and just how the world is. We want to change the world, and certainly Monetary Metals has a big vision for changing the world. But we have to start with a recognition of where the world is today and understand the reasons why the world is where it is today. And that's, it's a lot of work, but
very interesting. It's like when they say, there's got to be an alternative for YouTube or for Twitter. What's easier said than done, because everybody keeps going back to Twitter and they keep going back to YouTube, and that very simple set that helps me think about it like that in my mind, I guess.
That's right. Because why do you publish a video on YouTube? Because that's where all the viewers are. Why do all the viewers go there? Because that's where all the videos are. Now try to break out of that dynamic, and maybe and it's an interesting case because Twitter, Google, and with YouTube and Facebook seem to be going out of their way to really piss off like half of the world. I don't use Facebook anymore because they said, okay, we're going to ban you for 24 hours. I'm like, okay, I'm not going to play this game. I'm done. Goodbye. and I took myself and my content, elsewhere. But on Facebook, if you post anything related to seemingly a growing number of topics, they put this little sticker right on top of your post that's like, maybe Keith is full of what. click here to learn the real truth.
Oh, geez.
It's like, that's annoying, that's offensive, and we'll see if somebody can displace them. I suspect somebody may. I suspect that in the case of Facebook, they've actually gone too far. But YouTube and Twitter are probably better examples of companies that have gone pretty far to annoy at least half their users.
Yeah, and then once you do displace them, well, who's to say that next thing is not going to get co-opted and go down that same path or things like that as well, right? So
what's that old rock song? Meet the new boss, same as the old boss.
Yeah, exactly.
Oh, the Who won't get fooled again, right?
So Keith, let's talk about gold for a second here, Keith, because I know you got a gold outlook, and I didn't make any predictions or any forecasts or anything for gold. Definitely, I'm like the last person on the earth trying to hold off to back up my truck for silver in the teens, and I don't know. I'm hoping I'll be able to do that because I don't really want to work the math for my next back up the truck price. But let's talk about gold here for a second, because I know that you recently wrote an outlook for 2022 on gold, and viewers and listeners who are interested can go over to monetarymetals.com, download the report that you wrote for 2022. Definitely check that out. And here's my question with gold. Soon as I can find it. So like everybody got 2021 gold calls wrong, and I can't remember if you got it right or if you got it wrong specifically, but it seems like everybody and their brother got the gold call wrong in 2021. But here's my question with gold. So has your outlook for 2022, based on the events of the last week, has your outlook for 2022 changed? Or could you explain a little bit of your outlook for 2022? And is it now changing because of recent geopolitical developments, Keith?
The easiest thing to answer first is I don't think my outlook is really changing. And I'll just note that at the times when the news about Ukraine seems most dire, it's, the price of gold is jumping up. I'll note that the price of Bitcoin is crashing during those times, and along with stocks and a lot of other assets. And then when other news comes out to poo-poo that, it's not really that bad, it's fine, it's okay, look, just attack nuke, it doesn't really mean anything by that, then all of a sudden Bitcoin and stocks and all the, risk-on assets, rally. But I'll note that gold is definitely getting some safe haven, a very strong bid from the safe haven trade. But what I said in the Outlook 2022 report, and so no, in 2021, we didn't get the call right. So we actually went and retrospectively looked at our calls for the last 10 years. Overall, we did pretty good, but 2021 was not one of the good years for our prediction business, such as it is. But I think the forces, that we identified in 2021 are still there, which is, we don't tend to think in terms of quantity, quantity of dollars divided by quantity of gold gives you some hypothetical price. We tend to think that the dollar being a credit, it's not so much that the quantity of dollars is increasing, although it is, it's that the quality is decreasing. And as you get closer and closer to a default, then the quality comes more and more under question. So if you take a look at the bond price of an issuer as it gets closer and closer to default, it tends to hold pretty steady, decays a bit, and then abruptly there's this catastrophic moment, and then it just, which may be happening right now with the Russian ruble. I just saw a graph on Twitter of the ruble against the euro, and now it's all of a sudden collapsing. Like whatever, it has 2/3 the value that it did last week or something. It's lost 1/3, something like that in a week. And it's, you can call it stick slip dynamics, like adding, grains of rice to a pile, and then the pile will hold, it will hold, it will hold, and one more grain, and then the whole thing goes whoosh. It's a very nonlinear, kind of thing. But I think that as people look at what the monetary authorities, the Fed in the case of the US, but every bank around the world is really no different. When people look at what they're doing, it's logical they turn to gold and silver just as an escape hatch from the insanity. I remember my feelings about it. So I hadn't really thought very much about gold during the time I was building my previous company, which was a software company called Diamondware that I sold to Nortel in 2008. But right after that, I'd come into all this cash, and the transaction was August 19 of 2008. So this is literally right before everything began to blow up. So there I was watching. At first, I kind of felt bemused. It felt a little surreal. But then the more the things were crashing, the more I began to feel alarmed. And as I started to look for what can I do to protect myself, I had the feeling of being like an animal in a pen, and there's no exits. Like, the horse or whatever, the cow, will just sort of run around the entire circle of it looking for an exit, and there isn't one. Or there is one exit, but that's the chute that goes to the slaughter. That's not the one you want. And eventually coming to the idea of gold as an escape, an escape door from this pen that we're all herded into. And because we're fed and watered and whatever, life in the pen seems normal by comparison, and you don't know what the outside world is. So anyways, something like a 2008 causes a lot of people to come to gold for the first time, and myself included, that had never really thought of it before. And then there was an inrush of X number of people, most of whom presumably are still gold holders after all these years. And then you have a 2020, and then that's the next group of people, because not only did the Fed get a bit crazy, but then the fiscal authorities went absolutely bananas post 2020. And we had the so-called CARES Act, which is 2.3 trillion. And then they added another $500 billion because the 2.3 wasn't enough. So adding 2.8 trillion at the same time that they've just decimated revenues by shutting everything down in March of 2020. And you look at that and say, well, that's going to be, if they kept their books honestly, a $5 trillion plus deficit. So we've gone from a $1 trillion deficit to a $5 trillion deficit. And a lot of people turned to gold and silver at around that time. And we obviously had a big step up in price. Well, first silver really crashed in price, and then made up for lost time, and then obviously gold as well. So none of that's really any different. I think there's that visible increase in the insanity of the monetary system, which drives people to make their first purchase of gold or silver. And everything I said in 2021 is still there. In 2022, we said this is the hardest call to ever to make, because right now the Fed has promised that they're going to reverse. And if they're serious about that, and I don't try to get into the game of figuring out what do they say that they mean versus what do they say to just jawbone it. I mean, I don't know. They're politicians. I'm sure that they say whatever they feel they can get away with, or whatever they feel is going to work, or whatever. But if they're serious about going forward with this, then they're going to pull all the liquidity out of the market, and then certainly all the conventional asset prices. I mean, that's a recipe for a giant stock market crash. But also the credit, not the government credit, but the credit of all the marginal debtors will suddenly be under stress and beginning to default. I don't think the Fed cares about the stock market, but they care about credit. And keeping in mind that the equity is worth zero if a company defaults on its debt. So in that sense, indirectly, they care about the stock market. Anyway, so if the Fed is hell-bent on continuing this path that they've announced, supposedly we're going to see an actual rate hike in March, then we're going down one path, which is certainly not favorable to the silver price. And I talk about why in the Outlook report. I don't think gold will undergo the same kind of crash that silver will in this scenario, and I don't think it'll undergo the same kind of crash that it did in 2008. I think there's a lot less leverage in the gold market versus 2008, and more compelling reasons to hold it. But that's certainly not bullish for silver, and perhaps not bullish for gold. On the other hand, if the Fed realizes that they've just made some promises that they can't keep, And so, all that stuff, like a old Arnold Schwarzenegger movie. All that stuff that I said about tightening and rate hikes. I lied in that Arnold Schwarzenegger voice. I lied. If they take that path and they start pumping liquidity to to bail out the zombies and everybody else, then obviously the stock market will begin the next leg of its rally, and the prices of precious metals will be off to the races. And so I think we didn't call for $88 on silver, we called for 40. And $2,200 gold easily in that scenario.
So what happens if there's a third option, or in a sense of like the Fed is hiking, but at a rate that's slower than the rate of price inflation that's increasing? Is that a third option, or is that not something to consider?
I mean, either they're hiking or they're not. And if they're hiking, I mean, leaving aside the theory that hiking actually fixes inflation, which I don't agree with anyway. But if they're hiking, then that means the cost of credit is going up. So to talk about the cost of credit going up, the first thing you have to think about is the concept of a zombie. Now, this is not a term coined by Zero Hedge or some alt fringe of the internet. This is the Bank for International Settlements has this term. And I always like to talk about the movie Broken Arrow as, they come into the president's office, as I recall, "Sir, broken arrow, sir." And he says, "What the hell is a broken arrow?" "Well, sir, a nuclear warhead has gone missing, sir." And he's like, "I don't know what's worse, that a nuclear warhead has gone missing, or apparently it happens so often, you all have a term for it." So we have this term called zombie. And a zombie is a corporation whose profit is less than its interest expense. In other words, it would never exist but for not only one, really low interest rates, and two, a really forgiving credit environment. And now we're supposing that the Fed is going to make the credit environment less forgiving and drive up the cost of interest. Not only will that push all the zombies to default, which is something like 20% of all the corporate debt out there extant is zombie debt. 20% of all the corporate debt defaulting. What is that going to do? But in addition to that, the definition of zombie is based on the current cost of credit. You drive up the cost of credit. There are a lot of companies who today are not counted amongst the zombies who would be if you drove up their cost of interest.
Zombie creep.
That's right. And so that category of zombie. So when, by definition, the marginal whatever is the player whose behavior changes when there's a change in an independent variable. I think the marginal debtor is probably sometimes the narrow can be really narrow, and sometimes the margin can be really wide. I think it's probably a pretty wide margin that suddenly all these companies that aren't today perceived to be under stress will be in that environment. So I said in 2015, and it was the same story then, okay, minus Ukraine, it was the same story then, inflation and the need to hike rates. And I said, I don't think the Fed can really hike rates. And if they do, they won't be able to hike it very far, and they won't be able to hold it very long. And today we're in exactly the same boat as we were in 2015, except the situation is even more severe now than it was then, which means they wouldn't be able to hike it as far now as they did in 2015, and they wouldn't be able to hold the line as long as they did post 2015. So we'll see what they do. And obviously Ukraine only adds further tensions to that. I mean, how many Western financial intermediaries are owed money either by the Ukrainian government, that they buy Ukraine sovereign bonds, or by Ukrainian private corporations? Did the Ukrainian banking system sell any bonds into the Western world? I'm sure they did. Who owns those bonds? And now are they all staring at the write-downs to the asset side of their balance sheet? Of course, their liabilities are firm until they default, but their assets can go down. And how is all that playing out? The one thing you can be sure of is that today the Fed is much more aware of this stuff, probably, if anything, hyper focused on it versus 2008. And we'll see how it plays out, but I would be very dubious of that.
And are you still thinking that rates are going back down? Because everybody's saying, "Oh, the bond bull market's over. The bond bull market's over." And I know that you've been talking about the fact that over the last 40 some years now, we've had decreasing rates of interest, but we've had these moves up in interest rate. And sure enough, we've gone up to what, I guess over 2% on the 10-year, for example, recently. But are you still looking for the pressure just natural? Because that's why I asked about if they're hiking, but the rate of inflation is accelerating at an even faster rate. So are you still looking for the lower rates overall and a continuation of the so-called bond bull market? Or what are your thoughts on that, Keith?
Yeah, and in fact, my challenge to everybody who says this is it, this is the reversal, is what makes this different from all the other corrections. I mean, yeah, it's been 40 years of falling rates, but there's been corrections along the way. Somebody posted something to Twitter I found very interesting. He called it a caterpillar chart. And so it was overlaid with the Fed funds rate, where the predictions of all the leading economists, every time somebody had gone, I don't know, the Economist magazine or the Wall Street Journal, somebody had gone out and sampled all of these, leading economists. And at every little blip, there was this caterpillar, this little fuzzy line of predicting, oh, rates are going to go up, and they would extrapolate, rates are going to go up from here. And then, oh, that didn't happen. And 2 years later, again. And so it was this chart with the actual Fed funds rate with all these little caterpillar hairs that were all trending up and to the right in the imaginations of these economists that were polled pretty consistently over, many, many, many years. And so my challenge would be, okay, if you think this is going to happen now, what do you think drove the interest rate to fall for 40 years? And what happened that suddenly that driver is no longer in force? Because I have a theory as to what drove, the rate of interest down. And in my theory, that driver is still here today as it ever was. And that's essentially the market rate of interest is greater than the marginal return on capital. In other words, there is little to no demand for new credit except on a downtick in the interest rate. Mm-hmm. As the interest rate goes up, the demand evaporates. And so if you don't have corporations able and ready and willing to bid up the price of interest, then it doesn't happen. And you can talk about quantity of money, you can talk about purchasing power, you can talk about inflation, and how the investor allegedly the bond vigilante can demand an interest rate appropriate and so on. You can talk about all that stuff, and that's theory, but where's the demand for credit as rates go higher?
No, it's not
so
there, right?
From after World War II to 1981, every time the rate went up, there was ferociously, aggressively, urgently, more and more bidding to push it up even more. And that was a very different universe than the one that we're in today. And, corporate strategies, just the whole view of the world was the opposite of where it is today. It was a period of corporate hoarding of raw materials and partially finished work in progress. Show me a corporation today that wants to increase its partially completed work in progress. Mm-hmm. I mean, the movement has been lean and just in time. Now, with supply chain disruptions, they're reluctantly trying to store a buffer as inventory, but only the minimum necessary to tide them through. They don't want, to start building warehouses to store partially completed stuff.
And so let's stick on this for a second here, Keith, because I'm very concerned about supply chain disruptions, and I'm very concerned about the food supply, and I'm very concerned about the collapse of modern American society, Keith. And it's not just me that's concerned about these things. I talked to Charles Hugh Smith the other day, and he says, get out of the unraveling city while you can. I mean, that's pretty dire. And I talked to my friend, the Kansas wheat farmer, Brian Ochsner, from time to time, and he says the days of the 500-mile loaf of bread and the 3,000-mile Caesar salad are numbered. And I would tend to agree with that. And the empty produce in Washington, D.C. kind of correlates anecdotally with that. And just me personally, I feel that I could successfully argue that the U.S. dollar has already hyperinflated, and give various examples as to why, and that people are going to learn the hard way what it means to use an unbacked debt-based fiat currency that's dependent on exponential and sustainable growth. So just my question there is, a lot of people are really concerned, and I know you've had some bleak thoughts about this in the past. So just what is your outlook for Main Street right now, Keith? And how would you describe your outlook? Is your outlook still bleak for the future of America on Main Street, or are you optimistic, or just is it dire out there? What are your thoughts just on how Main Street is going to unfold here with these ongoing issues that I just mentioned?
I mean, I think this trade war and economic nationalism, if that continues, certainly reduces the quality of life, for most Americans. And then, which is funny because that's kind of the conservative side. The liberal side is energy poverty, with imposing pipeline bans and fracking bans and shutting down coal and opposing nuclear, opposing every form of energy that works, and wanting to push us to use intermittent, unreliable energy like wind, and never really asking the question, what if the wind doesn't blow? Oh, well, we'll have batteries. You have any idea what it's going to cost to build grid scale batteries? I mean, it's completely off the charts. So both sides are seemingly pushing policies that make us poorer and live more poorly. Certainly that's not a good thing, and that impacts, most people. From a monetary standpoint, I have a very bleak outlook. If you read my essay, When Gold Backwardation Becomes Permanent, that's my play-by-play, blow-by-blow look at how the dollar actually fails. And that's when gold withdraws its bid on the dollar. That said, I think that is still quite a ways off. I don't think that's imminent. So in terms of get out of the cities today, look, if your city is defunding the police and you have, mobs that are just howling for blood and burning down buildings and whatever, obviously get out of that. But if your city is, quote unquote normal, whatever that means anymore, I don't think this is that urgent. It's definitely something to be thinking about. There's definitely a very bleak end game. I just put the time frame for that end game a little farther out than even I thought it was. If you asked me in 2012 how much time I thought we had, I thought it was less than 10 years. Right. So now here we are in 2022.
Yeah.
And all I can do is I can cite Adam Smith and say, there's a great deal of ruin in the nation. It takes longer than you think, and there's more resources there yet to be squeezed out, like wringing water out of the sponge. There's more there than you think.
And on top of that, there's infinite numbers to the right of the decimal point. So it's like the dollar doesn't have to go to absolute zero to be worthless. There can be a lot of slowly over time losing value until it's outright rejection. Am I right, or is that the right
yes,
line to think?
It's like a stock. It loses 90%. Think, okay, well, it only has another 100% to go. But if it goes another 90 and another 90, no. But what I mean is, the dollar going to zero is actually a consequence of something else. And the something else is the collapse of productivity, right? So it's not entirely correct to say the dollar is unbacked. It's backed by debt. And the debtors and the struggles of the debtors are what give the dollar. Again, this is all perversity. I'm not in any way in favor of this, but it perversely gives the dollar its strength. So if you measure the dollar in terms of purchasing power, and every producer of every good that one might want to purchase is in debt, which most of them are. What do you have to do if you're in debt? You have to produce as much as it takes to dump that onto the market, pushing down the bid price of whatever it is you produce, desperately to raise the dollars to service your debt. So that is perversely giving an incredible strength to this currency that, by all reason and by all rights, should already have collapsed, given the abuses that the government has taken with it. And yet, the dollar continues to be there. Well, there's a relentless bid on the dollar from every producer of everything, every farmer, every miner, every manufacturer, every distributor, every trucking and shipping and logistics company is relentlessly bidding on it. And that's going to continue, because if you don't, if you're a farmer and you don't produce the wheat and dump that wheat on the bid price, then they come and take your farm and probably your house and your life savings. Most small business owners sign personal guarantees on all their debt. So that continues. And then all these producers are constantly, this is the deflationary cycle. So deflationary cycle. Every producer is constantly pushing themselves to find ways to produce more. And they do, and have been doing, for many decades. And, I don't see an end to that trend.
So Keith, last question here. Just leave our viewers and listeners with something in a sense of what is on your radar the most as we move from winter into spring, because my goodness, Keith, it's funny because, some things just come out of nowhere and hit us on the back of the head like a 2x4, and then some things just disappear out of nowhere too. And it's like, wow, it's really weird. Just all of a sudden, people flip a switch, and what you talked about for the last who knows how long isn't even talked about anymore. And now there's this new thing in town. So what is on your radar the most as we finish out winter and we move into spring? Because I'm kind of looking forward to my backyard garden personally and growing some tomatoes and some cucumbers and some chili peppers. But what are you looking at, Keith? What is on your radar the most as we move into spring here?
Well, if I wanted to be flip, I would say it's out with COVID and in with Ukraine. So the internet is going to abandon its expertise in viruses and disease vectors and vaccines, and now they've all taken up expertise in the geopolitics of Ukraine and Eastern Europe. But that's just being flip. What's on my mind right now is some of these non-monetary forces that are going to be driving up prices. I'd be particularly watchful for how much crop is planted in the UK. Right? Are they going to get the fertilizer in from outside? How is that going to work? And if it doesn't, then presumably the foods you're eating now was already produced last year. But if you're not, we're getting to springtime here pretty soon. If you're not planting crops, then what are people going to do for food, this coming fall and into next winter? And you can tell people it's not monetary all you want, but at the end of the day, if the price of food is up 10 times, you can have a riot and civil unrest anyways. And whether it's monetary or whether it's non-monetary may not really all that matter all that much, as the peasants have the torches and the pitchforks, and they're howling for blood. So where this all goes, I don't know. My gut is telling me that 2022 is still too soon. Even in the UK, I mean, it'll come to the US last. But I think it's too soon even for the UK. So I think they'll find some other source of capital to consume. They'll break out another store of seed corn somewhere and keep things going, for a while longer.
So there you have it, folks. In other words, can you have it held together by bubblegum and duct tape for just another year? Hopefully we can keep it together, because we'll be talking under much dire circumstances next time. Keith Weiner, I'd like to thank you for joining us again on Silver Doctors.
Thanks for having me.